Hey everybody, welcome to my live stream I'm doing at least recently it's been every week, updating you on, most importantly, what's going on with Dream for All, but really a Q&A session about anything you want to talk about, what's happening with the market, what is happening with the real estate world, what's happening with interest rates and loan programs. And so I want to make this open to you, and any questions that you have as you're watching live, feel free to post those questions and I'll answer your questions live. And then I'll have certain topics that I want to talk about. So tonight, the biggest topic that I want to talk about before I start getting questions from the live audience is the new changes that are happening with real estate and what is going on with the requirement to sign an agreement with a realtor before you view any properties. What does that mean to you as a buyer? How does that change the landscape? I've got a copy of the new agreement that I'm going to kind of do a brief overview with you to show you the things that you should be looking at. So I'm going to spend a lot of time talking about how working with your real estate agent is going to change in the next 3 weeks. But I'm also going to have time for Q&A. So let's go ahead and dive in first and see. First of all, I've got just a welcome. So the Connect Rock, is that what it says? Good evening. Good evening to you too. So if you want to see your name and lights, feel free to post just a good evening or a hello. For those of you who watch me fairly regularly, especially on these live streams, you've heard me get upset pretty much every time about my camera. So I have a nice Sony DSLR camera. It's nice. It was not cheap. And it seems to overheat. And I have no idea why. So if I could only show you right now, I literally have taken an ice pack and rubber banded it inside of a Ziploc bag to the back of the camera, hoping that it stops it from overheating. So we'll see if I can make it the entire hour on this camera instead of having to switch to the not so good camera on my laptop. But it certainly doesn't feel as high quality as it should, since I've had to rubber band. Actually, I didn't even rubber band. I had to hair scrunchie I wish I could show you a picture of it. But anyway, hopefully it works. We will see. All right. So again, I'm open to whatever you guys want to talk about. So anything you want to talk about, I am here for. But I want to start with a couple of miscellaneous things, and then I want to dive into buyer broker agreement and using your how it works with your relationship with your real estate agent as you go forward in buying a home. So first of all, remember, if you have any general questions, post them at any time. This is entirely for you and any questions that you may have. So the first, actually just got another comment. Here we go. All right. So the Connect Rock. What will happen if your credit score dips below the 680 threshold? That's a great question. That's a scary one. And I actually have 3 buyers in that exact situation where we did either a hard credit back in the spring, or they did a soft credit, or the lender they were working with, whatever it was. A credit report is good for 4 months from the day you pull the hard credit to the day you get your keys. And so when we're doing the Dream for All program, you have to meet all of the criteria at the time that you're doing the loan. So even though you had to get pre-approved at the beginning of this year, so I have 3 people right now that are working to get their credit score up. And the answer is you cannot buy until you meet the minimum criteria of the loan program. Now, if you're below 80% of the area median income, then you can purchase with a 660 credit score as your minimum. But if you are below 660 and under 80% area median income, or you're below 680, you're in trouble. And the only solution is to work on improving your credit. And it's got to be things that can happen quickly. So the biggest quick things you can do to improve your credit typically are the things that actually damaged your credit. And that is increasing your utilization is a bad thing. Utilization is the percent you owe compared to the credit limit. And it is the number one reason why I've had people's credit scores drop, because they charged up some money this summer. They went out and went on vacation, didn't expect to win the Dream for All, and now their credit score has dropped. You got to pay that balance back down. But here's a dirty little secret. It's a percentage. It's a percentage of what you owe compared to the credit limit. So you can either decrease what you owe. Let's use simple math. It's $1,000 credit card and you owe $800. That's 80% of the credit limit that you have charged up. Most people say, gosh, I need to get it to 25% of the credit limit. So if I take that $800 and I pay it down to $250, then I am now below 80% or below 25% utilization. That is true. But you also can raise your credit limit. People think Increasing their credit limit is bad. It's not bad. It's good. You need to raise your credit limit. Call up your credit card company. Say, hey, I've been paying you on time just fine. I want you to increase my credit card limit, and I'm looking for a limit of $5,000. Will you give it to me? Like, ask them for what you want. If you say you want to raise, they're going to okay, well, we'll bump your credit score. You'll bump your credit limit from 1,000 to 1,500. That's great. That gets you from 80% utilization to a little bit over 50%, but it doesn't move the needle a lot. But if you said, hey, I'm going to get to a $5,000 credit limit, that's what I'm looking for. If you paid them well, if you've overall had very good credit and it's just dropped right now because of high utilization, a lot of times the credit card company will in fact bump your credit or your credit limit, which will improve your credit score. The last thing I'll say about utilization is it's per card. So if you say, well, I got 5 credit cards that are paid off in full, and I've got 1 credit card that's maxed out. And so my utilization on my Credit Karma app says that I'm only at 10% utilization. No, you have 1 card at 100% and 5 cards at 0. And it's that 1 card at 100% that's killing you. So utilization hopefully is what caused your score to drop, and hopefully is what allows it to increase. If your problem with your credit score is because you had a late payment, you're in a little tougher situation. Unless you can convince the creditor that it wasn't your fault, the chances of them eliminating that late payment off your credit report are slim to none. Like you don't call them and say, hey, please, will you fix my credit? Because it's kind of hurting my ability to buy a house. And I just have such a sob story. They're not going to care. I hate to say it. They're not going to care. So what you have to do is you have to make it their fault. If you say, hey, I mailed it on this date and I wrote the check on that date, or I processed it and your system was down, and I don't know, whatever it is, if you can convince them it's their fault, you have a better chance of them waiving it. Especially when you say, hey, I've been a great customer up until now. This was 100% your fault. They're going to say, prove it. You say, I can't prove it, but it's your fault. They're more likely to give in than if you say, okay, here's the truth. It was my fault. They're not going to let it go. So be very, very careful about that. The other thing is you have collection accounts. One of my clients had a collection account that popped up that they knew nothing about. The problem is if you go through the normal dispute process, it can take 90 to 120 days to work through that dispute. For him, I said, look, do you want to use your money? The Dream for All voucher? He said, yeah. And I said, then pay it off. But before you pay it off, get a letter that says when it is paid, this will be deleted from my credit report. It's called a pay for delete. Now, it's a full-time job to get a collection agency to be willing to delete something off of your credit report when you pay them. Why do I say it's a full-time job? Because they don't want to do it. They're going to tell you, hey, yeah, we'll show it as 0. Once you pay it, we'll show it as 0 on your credit report. That doesn't help your credit score. It doesn't help your credit score because the collection and the fact that it was there is what hurts your score. Paying it to 0 does not help. So you get them, you call, you say, hey, I want to pay you. Great. Here, let me give you our account number. You can pay us. No. Hold on. Before I pay you, I want you to agree that you're going to delete it from my credit report. I'm sorry, sir. We can't do that. We're not allowed. It's against the law. Do you want my money? Well, of course we do. Great. Then give me a letter that says you're going to delete it from my credit report. I'm sorry, sir. We can't. Do you want my money? Of course we do. It's repeat over and over again. At a certain point, they're going to say, I can't do anything for you. You say, great. Can I talk to your supervisor? And then their supervisor. And then you hang up and you start over with somebody else and you talk to them and then you talk to their supervisor. At a certain point, somebody at the collection agency wants your money more than they want their name on your credit report. So just be persistent. That is another way that you can improve your credit score, but you have to think outside the box. You cannot follow normal channels to improve your credit score or you're going to lose the ability to use the money. All right. Aaron has a question. Excuse me, Annie. I'm sorry, Annie. How long does CalHFA take to process the loan with Dream for All? CalHFA is taking like a day. It is super fast. We just submitted another one in last week. I got 2 of them approved next day. So we submitted one on Monday. We got it back on Tuesday, submitted one on Thursday, and got it back on Friday. So they are going very, very fast. They're working weekends. They're keeping all hands on deck. I am super proud. Again, I think I said last time proud. I'm not proud because they're not mine, but I'm happy that CalHFA is dedicating the resources to keeping these moving quickly. So then it's up to your lender. I have a client right now buying a condo in Los Angeles, and we got the contract in 2 weeks ago. We're supposed to close 2 weeks from today, and we are submitting for final approval. We just got the appraisal back over the weekend. and we are submitting for final approval either tomorrow or Wednesday. We'll have final approval by Thursday, and we can close as early as next week, Monday or Tuesday. So that was pretty much 3 weeks from start to finish, including the time with CalHFA. So these are really up to your lender and how quickly they can go. CalHFA has not been the problem. All right. What is an origination fee? So an origination fee is it's the money your lender is earning for doing the transaction. It's that simple. For Dream for All, it's the money your lender is earning for doing the transaction. I've seen people typically ranging anywhere from 1.5% to 2.5% of the loan amount as a fee for doing the loan. The most common I'm seeing is 2% of the loan amount as a fee for doing the loan. And you have to understand that these are more expensive loans on the front, on the origination, because banks are not making the money they normally would on what's called the back. So the front is what you pay us. The back is what we make over the life of the loan by servicing the loan, by processing your checks, by being your customer service department. We originate loans, and then there's a value to the servicing. We don't get that value of the servicing. So the banks make a lot less money on down payment assistance loans compared to regular loans. Even when we're charging more upfront in origination fee, we're still making a lot less money, but we're willing to do it because it's taking care of people. But you can't do it if you're losing money. And if we are charging normal loan, you're paying normally around 1 point is the average. 1 point is 1% of your loan amount as an origination fee. So for the Dream for All program, you're going to see higher cost up front because there isn't any money the bank is earning over the lifetime of the loan. And so they have to charge more up front to really make it worthwhile for them to do the loan in the first place. All right. The Connect Rock says, thank you. You're welcome. All right. I was thinking about The Rock and the song in Moana. You're welcome. Anyway. All right. Atul says, I'm 134 on the wait list. Has only come down to 110 in a month in the Bay Area. Has CalHFA overestimated 3 times the wait list, or should I still be hopeful? Is CalHFA going to extend after 90 days those who have not used the voucher? There is a lot in there. The first thing, the fact that you've dropped from 134 to 110, I feel is pretty darn good. So in the Bay Area, you've dropped for 24 points. There's, I think, 300 and some odd winners in the Bay Area. So about 10%, 8% fallout in the first 30 days. That my estimation had us at maybe 25 to 50% fallout over the 90 days and more of it at the end of the 90 days, in my opinion. So I think we're right on track, if not better off than what I was estimating. Now, did CalHFA overestimate? They did. Like, they for sure did. CalHFA, a year ago, when they told me they were going to use a wait list, they said, we are going to create a wait list with as many people on the wait list as there were vouchers issued. Okay. So only one time the number of people on the wait list. And then we got the vouchers and we realized they had issued significantly more vouchers, significantly more people on the wait list. And the question became, what was their reason for doing it? And I asked, and they were very clear. We wanted to make sure there was zero chance we were ever going to have to open up the lottery again. So we tripled the number of people on the wait list to make sure that there would never be a chance that the wait list runs out before the money allocated for that region runs out. So yeah, they way overestimated on purpose. So if you were at the top of the wait list, meaning the furthest away, the highest number on the wait list, CalHFA believes there is zero chance that you are going to get your voucher. Zero chance. Now, anything could happen, but they probably thought, man, we think maybe we'll get to, the 1-to-1, the equal number of people on the wait list. Maybe we'll get through that. Most regions probably not even get that far, but in some regions it might go further. And so, well, should we double it? Yeah, I think double is safe, but we gotta make sure that it's going to be extra safe. Like, this is how I'm thinking they're talking. Okay, I wasn't in the room when it happened, but somebody was in the room where it happened. And the fact is that you have to imagine they were saying, look, there's just no way. If we triple the number of people on the wait list, there's no way we'll ever get there. So for sure. They overestimated, but I do think you should be hopeful. Honestly, being in the low hundreds in the Bay Area, I feel like you've got a good shot, but the timing is going to happen. Most likely, you're going to notice the biggest jump at the end of the 90 days. On September 26th, when the first group of winners runs out of time, you're going to see your numbers drop significantly, and it'll give us a really good idea of how long it's going to take, or if you even have a chance. If you only drop a couple of spots by September 30th, then you have no chance. But we will know by then, and I'll be able to run the numbers and do some approximation for you. The final thing, again, there was a lot in here, is you said, is CalHFA going to extend after the 90 days those who have not used the voucher? They've said there is an extension process, but they're going to be very cautious on who they extend for and why. So in my opinion, they are not going to extend just because you didn't find a home. You've got to have some pretty serious extenuating circumstances. In my opinion, I don't know what would be. I don't want to say it and then you say later, well, John, you said on your YouTube video that this is something they would approve and they didn't. I don't know what they're going to approve. But I'd imagine that if you personally were hospitalized and you were in a car accident, you were in the hospital for 60 days, then you could prove that. That's a fair circumstance in which you could say, look, I won the voucher. I literally spent 60 of the 90 days in the intensive care unit and I was not conscious. I think that would be a circumstance in which they would give extra time. I think somebody saying, look, I've looked and there's just nothing in my price range and I really want to buy a house and I've written 14 offers in the last 90 days and none of them got accepted and I need more time because there's just not enough homes. I think they're likely to say no. I think they're likely to say, look, we've got to give it to somebody else and give them the shot. Now, I also think that if you got into escrow on a home and you canceled it within a week or two of when the voucher expiration date is, I think they're more likely to say, okay, you were trying, you were in escrow and you canceled it. We need to give you a little bit more time to shop. I think that might be a situation. It is impossible to tell. All right. Annie says, thank you so much. How will the Fed meeting tomorrow affect mortgage rates? And is it better to wait before locking an interest rate? Ooh, yeah, I love these questions. All right. So the Fed meeting is tomorrow and Wednesday. They will announce on Wednesday what their findings, what their thoughts are. It is all but certain that they're not going to drop interest rates tomorrow, but they're going to make it, or Wednesday, but they're going to make it clear that they're ready to. Okay. That gives them the runway, that gives them the room to drop interest rates at their September meeting. But everybody believes that to be true, which means it's already built into the interest rate. We've already seen interest rates drop some. We saw today, CalHFA Dream for All is at 6.625. So the market is already lowering rates in anticipation of what the Fed is thinking. There's an old adage when it comes to the stock market that says, buy on the rumor and sell on the fact. When the rumor is that Tesla is doing really good and they're going to have great earnings, buy right then. When the truth comes out, whether the truth is good news or bad, whether it confirms the rumor or not, if the truth confirms the rumor, it was already built into the numbers. If the truth is the opposite, the only thing that's going to happen is the stock's going to go down. So buy on the rumor and sell on the fact is the old adage in the stock market. It's kind of the same is true with interest rates. So Annie, the question is, do you wait? It's a gamble. And it depends on what the gamble is worth to you. Because ultimately you have a limited amount of time to find a home, to get an offer accepted, and then to lock that interest rate. We cannot submit your loan for final approval or to CalHFA until you've locked your interest rate. So you're risking, hey, I could save 0.25% off my interest rate. You could, but it could also bump your interest rate up 0.25%. So is it worth the gamble? But the answer is, do I think interest rates are going down on Thursday? No. Wednesday? No. Do I think Friday is going to have a lot to do with rates? I think Friday is going to be a bigger mover of interest rates because Friday is the jobs report. That's the number one thing the Fed is looking at. So the jobs report is the first Friday of the month. The jobs report, we call the non-farm payroll report from the BLS, or Bureau of Labor and Statistics. And they publish that report at 5:30 in the morning, every first Friday of the month. And it tells us what the unemployment number is. It tells us how many jobs were created. If that unemployment number goes down or the number of jobs is significantly above what we expect, the Fed may say, you know what, no more. We're not thinking about lowering rates because clearly the job market is too hot and we are likely to see more inflation. Now, it's pretty clear that's not going to happen. The market's already planning that the jobs numbers are going to be reasonably lower. But if there's any uptick in jobs or any decrease in the unemployment rate, you're going to see rates jump on Friday. Now, that's my prediction, my opinion. The true reaction could be anywhere out there because it really is a gamble. All right. Hopefully that helps. All right. I am not going to try and Ali Velumanga says, I heard the Dream for All program closing costs are about $20,000. Depends on your loan amount. What I'll tell you is I tell my clients, I tell all of you, expect around 4%. So expect around 4% of your purchase price in closing costs. That's an overestimation. The truth is it should be around 4 to 4.5% of your loan amount. So if you project 4% of your purchase price, here's the challenge. The challenge is if you're buying at the low end of the price range, if you're buying at a $300,000 home, there are a bunch of fees that you pay that are fixed dollar amounts. You're going to pay an appraisal. That appraisal is pretty much the same whether you're buying a $300,000 home or a $1.1 million home. But the appraisal fee is a larger percentage of the $300,000 home. The underwriting and processing fees and credit report fees are pretty much the same for everybody. Now, your fees like title insurance and escrow fee goes up a little bit. When you double your loan amount, your title and escrow fees go up incrementally, not double. So it's a much bigger percentage of your small loan amount. So normally on your larger loans, you're borrowing $500,000. You're looking at, hey, 4% of $500,000 is around 20 grand. That's a pretty realistic number. The truth is, if you're borrowing $1 million, you've got some other fees. So the title insurance fee and the appraisal fee are a much smaller percentage, but now you've got a high balance fee that you have to pay for. Now, some lenders have a fixed cost across the board for their origination fee. I don't. I have it tiered. So it is a higher cost for your lower loan amount, but the fee goes down if you're in the higher loan amount. But yeah, $20,000, if you're buying $500,000 or $600,000 range, that's realistic. But you can build it into your loan amount. You can borrow that money. Now, that means you have mortgage insurance. Most of my clients are opting to pay that mortgage insurance as a one-time fee instead of paying a monthly fee. So you get the same interest rate, a little bit higher monthly payment because you're borrowing more money, and we just tack in the mortgage insurance as a one-time fee into your fees, and now you can get into a home with literally no money out of pocket. I've got one client right now, my first one that we're closing. I've got 8 in process right now. The first one that we are closing, and I'm finalizing their numbers right now, and they're literally getting every penny back they put into the property minus maybe $200. So their earnest money they're getting back, their appraisal fee they're getting back, their credit report fee they're getting back. I just can't narrow the numbers down perfectly, so they're probably going to be out $200 at the end. All of the closing costs are built into the loan amount for them. That's what they chose, so they don't have to come up with that 20 grand out of their pocket. All right. Atul says, thank you, I'm the best. I appreciate that. All right. Veronica, can I explain buying down interest rate offers? Yes, I can. Hold on one second. All right. I love this. I love all the questions. Okay. I actually have a spreadsheet that I covered this, I think, last week, but I'm happy to try and pull it up and share it with you. Buying down the interest rate. I'm going to explain it without the spreadsheet, and then I'll see if it makes sense to add the spreadsheet in. Buying down your interest rate means you are paying a fee now to pay less interest and less in your monthly payment later. The simple way I explain it to people for years, I've always said it this way. Let me see if I can fix this. All right. I've always said, if I told you, Veronica, that if you pay me $10 right now in more fees, I'm going to lower your payments by $1 a month. Would you say yes or would you say no? Now, I'm not going to wait to see your answer come up here. I'm going to say, well, you should say yes, because just in the first year, you'll have saved $1 a month times 12. You'll have saved $12 in your payment because you have a lower interest rate and you spent $10 once. Now, there's an extra component of this that is has to do with what's called the time value of money. It's inflation, right? If you have $10 today, $10 right now buys you 2 gallons of gas, okay? 5 years ago, $10 would buy you 4 gallons of gas. So is $10 worth the same 5 years later? It's not. So you have to kind of add that in there, but that makes the calculation much, much harder to digest. So I'm going to ignore that. For those of you who understand that, I'm absolutely saying I'm ignoring the time value of that money. You simply say, hey, I've got $10 that I'm giving an extra fee. I'm buying down my interest rate by spending $10. And in return, I'm saving $1 a month. That is a really good deal. Now, if I said that I'm going to charge you $60 to save you $1 a month, well, wait a second. In a year, I'm only going to save $12. I'm going to have to keep this loan for 5 years in order to break even. And now in 30 years, I'll have saved $360. So some might say, well, of course I should do it. Of course I should buy down the interest rate because I'm only spending $60 and I'm going to save $360 over the next 30 years. But you're not going to have this loan in 30 years. You're probably not going to have this loan in 5 years. Now, nobody knows how long for sure you're going to have the loan, but you got to think about probabilities. The banking industry does. We know that the average person keeps their loan a certain amount of time. Now, that vintage, the age of how long somebody keeps their loan has gotten longer. Why? Because people have gotten super low interest rates and they don't want to get rid of them. People who are taking out loans today, the prepayment speed, the vintage, how long they're going to keep that loan is very short. We expect everybody who gets a loan right now to refinance in the next 2 years, except people with Dream For All. You can refinance once, but you can't refinance after that without paying back the state. So your loan is likely to last longer. You're not going to refinance at the first chance to save money. You're going to wait until you're saving enough money. And so the banking industry knows that, and they're kind of banking that into the numbers. But very, very simply, buying down the interest rate is you deciding, is it worth me spending X amount of dollars now to save a little bit off of my monthly payment? Don't think about your rate. Rate buys you nothing. Rate buys you nothing. Okay. Rate is the thing that is used to calculate how much your monthly payment is going to be. It is kind of like saying, look, by the way, I'm not a car person, but hey, this car has, 490 horsepower. Okay, I have no idea what that means. I have no idea if that's good or bad. People who are car people will know that, John, you're probably crazy, like 490 horsepower means nothing, or that's too much or too little. I don't know. But hi, Tammy, by the way. Tammy gave me a thumbs up. So I don't know whether 490 horsepower is good or bad. It's relative. It's relative because you're going to have a friend who says, well, I just got this car and it has 450 horsepower. Oh, man, mine's got 490. I don't care. Like when I hit the gas pedal, can I accelerate fast enough to pass the person that is coming up on my side? Like, that's what I want to know. So we all focus on interest rate because we don't know anything better. You don't know. And I understand you don't know how to compare lenders. You don't know how to compare one deal from another. You don't know how to know whether you're being taken advantage of or not. And so the interest rate, when you say, oh, I'm buying down my interest rate, that means I'm getting a better deal. No, it really doesn't. It might, but there's more to it. Now, there are certain circumstances when you just plain need to buy it down because it's the only way to qualify. I have one client in Southern California. He's in contract on a home right now. His homeowner's insurance came back at $9,000 a year. He's paying almost $800 a month for homeowner's insurance because he's in a high fire zone. I factored about $200 a month for insurance. So he has a $600 a month higher insurance payment than we were projecting. Now, if he wants the home, one of the things he might have to do is buy down his interest rate, because if the debt to income ratio is too high, then buying down your interest rate, once you've paid off your debt, by the way, there's really 3 ways to get yourself from too high of a debt ratio to low enough of a debt ratio. Pay off debt, put a bigger down payment, but you're limited to only 5% of the down payment of the purchase price, or buy down your interest rate. Those are the only 3 ways that you can throw money at the problem. Now, in most loan programs, you just lower your loan amount. But in this loan program, that's not an option. You can only put 5% of your own money down. So therefore, how do you get yourself out of a pickle where your debt to income ratio is too high? Pay off some debt or buy down your interest rate. That's another situation in which you really do need to use it. All right. Clarissa's back. All right, Clarissa, can you clarify LTV ratios in the 95-105? I sure can. When you take so there's two numbers. There's called loan to value and combined loan to value. So the combined loan to value is how CalHFA is making sure that you never put more than 5% out of your own pocket. Because CalHFA says your combined loan to value is how much you owe on the first mortgage, plus how much you owe to CalHFA for their loan, compared with the value of the home. And so in most situations where you're under a $750,000 purchase price, you say, okay, I'm buying a $600,000 home and I'm getting $120,000 from Dream for All, 20%. So that means that if I apply that 20% to the down payment and I pay my own closing costs, then my loan to value is 80%. I'm borrowing $480,000 on a $600,000 home. But when I add together the $480,000 first mortgage plus the $120,000 from Dream for All, that adds up to $600,000, which is 100% combined loan amount compared to the value. So that's 100%. And you say, I want to put 5% of my own money down. That's how they control it, because they say, okay, then the biggest down payment you can put is 5% from your money plus the 20% from the state. So in that case, $30,000 is 5% of 600 grand. So now instead of borrowing 480, you're borrowing 450. 450 plus the 120 equals 570, which is 95% of the value, $600,000 on the home. You can't put more down, because you put more down and you want to say, I only want to borrow 400,000. Well, 400 plus $120,000 is 520. That is less than 95% of the purchase price. Where this becomes more confusing is when you're over $750,000. When you're over $750,000, I'll use $1 million as an example. Your money from the state is 150 grand. So your loan amount can be, if you think about the 150 plus your 5%, that's $200,000 that you're putting as a down payment, because you're putting $50,000 is 5% of the $1 million purchase price. So you're combining the 150 and your 5%, which means you're borrowing $800,000, 80% of the purchase price. You add together your second loan of $150,000 and your $50,000 out of your pocket. That's $200,000 that you're putting as a down payment. I feel like my math is off here a little bit. Anyway, I'm going to stop there because I'm positive my math is off and I'm not going to try and repeat it. The loan to value is how much you owe on the first mortgage. The combined loan to value is how much you owe between both. And that total between the first and the Dream for All loan has to be between 95 and 105% of the purchase price. Why would it be 105%? Because I'm loaning you extra money to pay for your closing costs. It's that simple. When I loan you extra money to pay your closing costs, then your combined loan to value is going to be over 100% of the purchase price. All right, hopefully that helps. All right, if I get $140,000 as 20% closing costs, can I take the remaining $10,000 as my closing costs? What you're missing is what's your purchase price. So if your purchase price is $750, then yes, you can. Or even if your purchase price is $1 million, yes, you can. You can do exactly what you're talking about, because you can spend the Dream for All money any way you want. You can allocate all of it towards down payment or some of it towards closing costs and the rest towards down payment. But what you can't do is if you bought a $700,000 home and you said, well, John, everybody gets up to $150,000. So I'm buying a $700,000 home. And I think that's what you're saying here is I'm buying a $700,000 home, which is 20% of that's 140. Then that's all you can get from the state. You can't get more money for closing costs. You can't get the rest of the 150. You're not entitled to the full 150. You're entitled to 20% of the purchase price up to 150. So if you're buying a $700,000 home, your 20% from the state is $140,000. That's all you get from the state. There is no extra $10,000 that you can tap into for closing costs. If you want $10,000 for closing costs on that $700,000 home, then you're actually using $130,000 for down payment. And now you're no longer putting 20% down because we're loaning you more than 20% of the purchase price because you took some of the money to apply towards closing costs. Hopefully that helps. All right. What other changes will there be? What other charges will there be other than closing costs? So I'm gonna break that down a little bit different than maybe the way you say it. All of the fees that you pay to the lender are closing costs. There's lots of them. There is your first year's homeowner's insurance. You're going to prepay interest for the month that you buy in to get you to the end of that month. You're going to pay for property taxes. You're going to pay a proration towards property taxes. You're going to pay an appraisal fee. You're going to pay a credit report fee. You're going to pay all of the title company's fees. Title company has escrow fee, owner's title insurance, lender's title insurance, notary fees, recording fees. You got a bunch of fees that are listed here. You've got fees for CalHFA is charging some fees for processing the Dream for All loan. So you got lots of miscellaneous fees. You got a home warranty that somebody's got to pay for. So all of these fees are closing costs. And then you're going to pay for any inspections on the home. You're going to pay for a home inspection, a roof inspection, a pest inspection, a foundation inspection, whatever inspections you feel you should have. Just understand you're buying a used home. It's like buying a used car, then you get an inspection on the used car and they say, hey, these tires are worn down a little bit. Yeah, they've been driven on, right? Like, hey, the windshield is dirty, it's got bugs on it. Yeah, because it's been driven down the highway. Like there's things that are normal wear and tear. You should expect that when you're buying a resale home. What you have to be careful about is the things that are outside of normal wear and tear that are signs of a bigger issue. Things that are problems with plumbing. There's something called, there was a company actually back 2010, 2008 that was very, very popular in plumbing supplies. They created the pipes that go through your walls, and it was called Kitec, K-I-T-E-K. Kitec plumbing started bursting. The quality of the pipes weren't as good, and there was a major class action lawsuit. And the homeowners who owned the home at the time of the lawsuit got to claim, now a lot of them didn't, people didn't hear about it, but they got to claim that against the lawsuit, and they got money. Now, some people filed a claim, got the money, replaced the piping. Some people filed a claim, got the money, kept the money, didn't replace the piping. Some people never knew they could file a claim. They didn't even know they had Kitec plumbing. So you get a home inspector, and the home inspector comes back and says, hey, you've got Kitec plumbing. You need to be concerned about that. That's a red flag. That doesn't mean don't buy the home. Maybe it's priced well below the rest of the homes like it because it has Kitec plumbing. It doesn't mean the plumbing is going to burst and you're going to have a major problem. But it means that there have been quality control issues with those particular pipes, and you should be aware of that fact. So that is something that a home inspector is going to tell you. Okay, so those are the types of things you need to pay for separately, are the inspection reports. And again, it's up to you and your realtor to work together to figure out those inspection reports. All right, I love this. We're 40 minutes in, and it's all been questions. I'm on my last question. Layla Chapman, hi, is a second job going to disqualify you from Dream for All? That's a good question. So first of all, it's qualifying income. You can only count the income from a second job if you have if you've had 2 jobs for 2 years. If you just got a second job for the first time, we can't count it. It doesn't count as qualifying income. It cannot count towards your income for the loan. Therefore, it will not count towards your income for Dream for All. Now, if you've had 2 jobs for a long period of time and you add those 2 jobs together and it comes out to less than what the total is that you're allowed to earn, then you're fine. But what if you get a pay raise on one of those jobs and it puts you now over the limit? Now you're in trouble because now you can't count both jobs anymore. But if you throw away one of the jobs, your income drops significantly and your qualification goes down. I had a conversation about that with a client just on Friday. And he was saying, John, I get paid a salary and then I get paid a bonus. And with my bonus, I can qualify for $1 million home. But my bonus puts me over the limit of what the county is that I want to buy in. And we talked about his salary. And his salary, fine, he qualifies for a price less than what he wants to live in. So he's stuck because he has income that, if we count it, disqualifies him from Dream for All. But if we don't count it, he can't get to the purchase price he wants to get to. And so I talked to him about whether he might have a family member who's willing to give him trust income. Trust income is a type of income where you've got a family member that has a living trust. Maybe it's a grandparent that says, hey, I'm willing to help you. I'm going to give you an inheritance anyway. And you say, great grandma, not great grandma. You say, great grandma. By the way, this reminds me that punctuation saves lives, because if you say, let's eat grandma without a comma in there, you're a carnivore. You're not a carnivore. You're a, what's the word when you eat other humans? You're a bad person. Versus let's eat grandma with a comma there is just inviting grandma to eat dinner with you. So anyway, I digress. The fact is that if you said, hey, grandma, I know you want to give me an inheritance down the road. Would you be willing to set aside my inheritance money right now in a trust account and pay me one portion of it every single month for the next 3 years? Because grandma, if you do that, then I can qualify for a mortgage and I can help you to get that set up. And I can help you with the steps that we need to get grandma set up in that. And grandma puts that money in there, and that money is paid to you every month for the next 3 years in an equal amount. There has to be enough money for it to last 3 years. And now you qualify. So now I can take that income that you have, ignore the income that puts you over the limit, and take that inheritance money that grandma's paying you before she dies, and she gets to see you enjoy becoming a homeowner instead of you not getting the money until she's gone. So it's a win-win for everybody, and it's a great solution if you're in that situation where you're stuck in the middle of qualifying versus not qualifying. All right. When do I need to start paying CalHFA the 20%? Is it after the first loan closure? Okay. So there are 5 situations. I don't know. Anyway, you must pay them back when you sell the house. You must pay them back when you refinance the house for the second time, or you must pay them back when you refinance the house pulling cash out, even if it's the first time that you refinance. And you must pay them back in 30 years when you finish paying off your primary mortgage. And you must pay them back if you go into default. So if you end up in a default situation on your home, and by the way, selling is also transferring. If you transfer the property to a family member, that triggers you having to pay it back. And paying them back does not mean paying them back just the 20%. It means paying them back the 20% and the portion of the appreciation that they are due. Now, one thing for those of you who are buying at the higher end price points, as soon as you go over $750,000, you're no longer getting 20% from the state, but you're also not paying them back 20%. If you buy a $1 million home and you get $150,000 from the state, they provided 15% of your purchase price. Therefore, they get 15% of your appreciation. So it's important to understand that distinction. All right, hopefully that answers your question. Since Dream for All gives you only one chance to refinance, will they allow you to do a rate buy down at the time you refinance? Sure, they don't care. That's one argument that says you should do a rate buy down now. I've had some people who said, John, maybe I should do a rate buy down now because it buys me, get it? Buys me? It buys me more time before I need to worry about doing another refinance. That's true. But what are you waiting for? Like, what's the magic rate that says this is when I'm going to refinance? But yes, you can do a bigger buy down at the time that you're doing that refinance. You're not doing the refinance with CalHFA. Now, I'd like you to do the refinance with me. Okay. I am interviewing to earn your business. If you have not been on here before, this is the link to get started. For me, I'm interviewing to be your lender. Okay. If you refinance, when you refinance, you can go to anybody you want. It does not have to be a CalHFA lender. We're not doing CalHFA loan at that time, but the lender needs to understand how to give you advice. That's something I'm very well prepared to do, to help you understand what it's going to cost you. And sometimes to advise you, hey, maybe you should pay off your silent partner, the state, get them out from underneath collecting your appreciation on your home. All right. So that hopefully answered that one. Is the amount for buying down interest rate calculated under the 20 plus 5 closing costs, or you can pay it out of pocket? You can pay it out of pocket. You can calculate it into the, your 5% extra that you can pay is solely about purchase price. It solely is how we calculate the loan amount. So you take the Dream for All money plus 5% of the purchase price and subtract that from the purchase price, and that represents the smallest loan amount you can do. Now, when you pay closing costs out of pocket, when you buy down the interest rate with extra money out of pocket. You cannot do a temporary buy down out of pocket. If you want to do a temporary buy down, that has to come from the seller's money. You have to get a seller credit. But if you pay off debt to lower your total debt, pay off a car maybe, pay off your credit cards, every dollar that you spend is acceptable. It's not calculated as part of the 5%. The 5% is simply what you can put towards down payment. You can pay for your closing costs. You can pay for your buy down fees, all of that stuff, and your debt payoff all on top of that 5%. Jeremy, welcome. All right, Jeremy says, if I were to buy a house today, put 5% down, and let's say rates drop and I want to refinance, let's say. What if the market shifts and I'm upside down in a year? Is that possible? At what point I won't be able to refinance? I think you're continuing it here. I know we're at the top of the market. At some point, it's got to come down. There are so many ways I can answer that, Jeremy. I don't believe we're at the top of the market. I don't know. I can't tell you what's going to happen. What I can tell you is that house prices should have dropped already because interest rates went up so much, and they haven't. And so there's been a huge weight on the shoulders of house prices, a huge burden pushing down house prices, and they've stayed afloat. Why? Because there's a lot of undercurrent keeping housing prices moving up, and it's the shortage of inventory plus the delay of people creating households. I could spend an hour on this, but I'll give you a 10-second. It won't be, it'll be 2 minutes. But basically what happened, and I know this is not your quick question, but I'm getting to it. Promise I'm getting there. 2008 happened. The market crashed. Builders stopped building, buyers stopped buying. Builders didn't start building homes again until 2015. Now they built some here and there, but they really didn't build very many. And that's okay because buyers weren't buying. Builders, people think, like right now, we have a shortage of homes. Builders just need to build homes. No, they don't. Builders are for-profit organizations. They're not going to build homes if there aren't buyers wanting to buy them right now. And permits for building new homes are dropping. The number of new home permits that are being allocated is lower now than it has been over the last couple of years because rates are so high and fewer people are out there buying. So builders are not building inventory for backstock. And they weren't doing it between 2008 and 2015. But guess what? People didn't try and move out yet. They went to college and they came back home and they said, I don't want to be an adult. I'm going to go live in mom and dad's basement for the next 10 years. No big deal. They saw auntie and uncle buy a house and lose it in foreclosure. And they said, I'm not becoming a homeowner. That's a bad idea. And they delayed buying a home. Now you have all those people who've waited like you guys who are saying, oh my gosh, it's time now. I'm going to do it. But you couldn't buy in 2020 and 2021, even though rates were super low, because there was such a big wave of competition. So many people wanting to buy compared to the number of homes available for them to buy. Now, that number of people wanting to buy has come down because the Fed jacked up interest rates, but it hasn't come down low enough to satisfy the demand that's out there, which is why the house prices have stayed the same. So they went up a lot because they dropped in 2008, 2009, 2010, 2011. What we saw from 2011 to 2020 was it catching up a little bit, it getting back on track to where it was supposed to be. And then we saw 2020 and 2021, it shoot way up. And then we saw 22 and 23 and 24 that it stays flat. So we're not higher than we should be. In my opinion, we're right on track with where we should be. We've just had some decelerations and then hyper accelerations to catch up. Okay. Now, that was a lot to get back to your real question, which is, what if the house price drops? Can I refinance? Kind of. So I've actually started looking into this again. These are recession era rules that Fannie Mae and Freddie Mac came out with that talk about high loan to value refinances, where, hey, the theory is Fannie Mae is already backing your mortgage. They are, because CalHFA goes through Fannie Mae. So they're already on the hook. If you can't make the mortgage payment, Fannie Mae has some skin in the game. And so if they can get you from a 6.75 rate to a 4.75 rate, it is a lower risk for Fannie Mae. And so they would rather do it. And so they created programs that came out because of the housing recession, because of the fact of what happened in 2008 with the Great Recession. And people couldn't refinance for the reasons you're talking about. They created programs to say, no, we got this high LTV program that says, we know that you're underwater, but we still want to help you because we don't want to have the problems we had in 2008 happen again. So they wrote the rule book for all of this. Now, I haven't dusted off the rule book. I got to pull it off the shelf and blow the dust off of it and read through it. And some of the components of it I know have been deactivated by Fannie Mae, but they're still right there. All I got to do is flip the switch to turn it on. So the government and specifically the mortgage world has watched what happened in 2008, looking at it in the rearview mirror and saying, what do we have to do to make sure that doesn't happen again? Because that was painful for everyone. So let's make sure we avoid that. I'm counting on that if what you're afraid of comes true. I also don't see it likely that what you're afraid of is going to come true. Hopefully that helped. All right, Clarissa, since this is a shared appreciation loan and I was able to watch your neighborhood video you sent, is there a way to select homes well so that the amount of appreciation pays back what is owed? That's the $1 million question, right? It's location, location, location. If you're in there isn't a way to pick a neighborhood that is going to appreciate. There's a company called Altos, A-L-T-O-S, Altos Research. And it's paid services they have that realtors can subscribe to. And they give demographics of certain regions and what has happened and kind of what they think is going to happen. There's a lot. It's just like predicting stock. Like, is Tesla going to go up tomorrow or not? We don't know. There's people paid millions of dollars to predict it, and they're wrong half the time. Okay. But here's what I'll tell you. The more competition you have for new homes in your neighborhood, the less your value is going to go up accordingly. That has been a general rule of thumb for me, and I've seen it come true. If you have more new homes being built and those new builders have incentives to get the home buyers to want to buy, and your home is exactly the same as those homes, the home buyer is going to come in and say, well, I can buy your house or I can buy this other house. And the house is brand new and it comes with a warranty and it comes with a super low interest rate. And so you have you have competition that has a better product and deeper pockets that needs to sell the home. Like, you don't have to sell the home. As a homeowner, you never have to sell unless you're in dire straits. A builder has to sell. Now, they're not going to build unless they know they can sell. But they'll build sometimes just barely breaking even and making money because they're keeping their workforce employed. They learned that lesson in 2007 as well, that, hey, we don't want to lay everybody off because if we do, they'll never be here for work when we need them back. So let's keep them employed. So they will do that. But is there a way to select homes where the appreciation amount pays back? You're looking at homes in more desirable neighborhoods. You're looking at homes in neighborhoods that often are more established. That's where having a great realtor is the one that's going to help guide you, because that realtor is going to be able to tell you, hey, historically, this particular neighborhood has gone up more than another neighborhood. My wife and I sold our house 3 years ago. The house we sold 3 years ago is worth almost exactly the same on Zillow as what we sold it for 3 years ago. The house we bought 3 years ago is up 15% in the last 3 years. We bought in a particular pocket, in a particular neighborhood that is more desirable. There's fewer homes in that area. There's no new building going on. I'd like to say I was super smart and I figured that out and knew going into it. We just desired the home in the neighborhood because it was great for us and our family. Well, that's also true then for everybody else who desired it, and it's driven up the prices in the market that we bought in. So that's a tough one, and there really is no simple answer to that. All right, like pay attention to home values in your area. And this is kind of an add-on to the question or statement you made. So yes, you need to pay attention to the home values in the area. You need to look at regions where prices have gone up in the last 3 years. Now, Jeremy's concern is, hey, if that region had prices go up in the last 3 years, then they're ripe for a drop. Maybe, or maybe it is such a highly desirable neighborhood that even in the toughest market we've had in the last 2 decades, well, not 2 decades, in the last decade, that prices still continue to go up, which means it's going to continue to be a desirable neighborhood. There's no sure answer to any of that, but you have to be willing to do research and then make the gut decision. And a lot of times buying a home is a lot more about gut, emotion, and feeling. I was listening to a podcast the other day, and they were talking about these two realtors, really, really smart gentlemen. And they were talking about the decision to buy a home. And they were talking to a guy who studies data about homes and about neighborhoods and what makes a neighborhood really good. And they asked him, hey, the house you're living in right now, what made you decide to buy that house? What search criteria did you use? What characteristics did you look for? And he said, that's funny, because my wife and I were just talking about the fact that when we bought our house, we didn't employ any of the stuff that we thought we would. We went and looked at the house and we just knew when we were there. We didn't have a really good data analytical way to know. We just knew when we were in there, we just looked at each other and we said, this is the one. They knew, when it is the right house, you know that it is the right house. All right. Andy says, does trust income work on other types of loans? Yes, it does. So most loan types, and there's a lot of nuances. A lot of people use this rule inappropriately, and there's ways to use it inappropriately. But if you're using it appropriately and you have a family member that's willing to give you an inheritance and pay you over at least the next 3 years, pretty much every loan program lets us count that. Okay, pretty much every loan program. Some loan programs are going to say, yeah, we want to see at least a year's worth of income. We want to see at least a year's worth of you receiving this money from your family member before we can prove it as income. Most loan programs are going to say, no, we just need to know that it's happening now and that it's going to continue for at least the next 3 years. So hopefully that helps, Andy. All right. It is 55 minutes, 56 minutes in, and I am out of questions, and I love it because that's what I want this to be. I want to talk about what I came here to talk about. Actually, I'm not. So here's the deal. I'm going to talk for a quick minute. Changes are coming on August 17th. I'm going to do multiple lives. I'll be gone the first half of next week, so I'll probably do it the latter half of next week. I will dedicate at least one of my upcoming lives in the next 3 weeks specifically to what is changing in the real estate world. August 17th, there is a settlement between the National Association of Realtors and a class action lawsuit that is requiring all realtors to change their business practices on August 17th. And a lot of people have made a really big deal out of it. A lot of people have said it's not a big deal at all, like much ado about nothing. I believe it's somewhere in the middle. But here's what you have to know as a buyer. You are going to be required to sign a piece of paper with your real estate agent as of August 17th before you visit a property. That piece of paper is going to say, I am hiring you as my realtor for this home, for all homes, for today, for the next 90 days. There's lots of variations to this. It can be exclusive. It's kind of like dating, okay? It can be exclusive. Hey, you and I are dating, and that's it. You're my realtor, and that's it. It can be non-exclusive. Hey, we're just kind of hanging out, and if we date other people, it's not a big deal. So there's a lot of nuances to it. The thing is, you got to educate yourself. I want to be the resource to educate you. Now, I am not a realtor. I am not an attorney. I'm not pretending to be either one of them. But you need to understand what questions to ask. You need to understand that everything is negotiable. And so when a realtor sits in front of you and says, hey, sign this form, we're going to go look at a house today, and you're agreeing to use me as your realtor for any house that you buy in the next 90 days. You just met him today. Seems like a pretty big commitment to take. Some realtors already have told me, John, that's all I'm doing. If somebody's not willing to do that, I'm not willing to do business with them. That is entirely their choice. And it's entirely yours to agree or disagree or negotiate. So if somebody puts a piece of paper in front of you that you've never met, that you, for the first time, you want to go see a home with a stranger, and they say, no problem, just sign this piece of paper. Read the piece of paper. Ask them clearly what it says. Look at the boxes. I am going to show you the form, and we're going to walk through the most important things you have to pay attention to. But you need to know, in the state of California, there is a difference between exclusive and non-exclusive. And it is non-exclusive unless they check a box that says it's exclusive. Exclusive means you are their realtor, they are your realtor, and you are working with them. Now, they can't make the agreement longer than 90 days, but they could make it a week. They could do it week to week. They could do it month to month. But you have to know the right questions to ask before you sign a piece of paper, because when you sign it, you are bound to that. There's going to be a number on there that says you owe X amount of percentage or dollars or both when you use them to buy a home. Know what that number is. Know what it means. Ask questions. Okay, I'm going to help give you the questions to ask, because I'm not telling you, look, this is a good thing for realtors. Let me give you a little bit of the other side of the coin. As a realtor, they have zero guaranteed income. They can take you out and looking at homes every single weekend for 6 months, and then you happen to walk into an open house, see a perfect home, and you write an offer with the realtor that's inside that open house. And they just spent 6 months donating their time, working pro bono for you. That's not right. That's not fair. That's not appropriate. And you shouldn't expect them to do that. You shouldn't expect them to drop their plans on a dime to come take you to find a home, and then you bail on them later because you found somebody else willing to do it a little bit cheaper. So this is about doing business the right way. But doing business the right way does not mean that you're committing to the wrong person because, well, the law says you have to sign this form, ma'am. I don't have a choice. You have to go look at this. You have to sign this form in order for us to look at the house. But they don't explain to you what the form says. They don't explain to you what you're signing or what you're agreeing to. And now you've committed to this person that may not be the right fit for you. And you may not have a lot of options to get out of it. There are some options built into it on how to get out of it, but it's got to be mutually agreed upon. Well, what if the realtor doesn't agree to let you out of it because you signed the exclusive version for 90 days saying if you bought anything anywhere in the state of California, you're paying them even if they never talked to you about the property, which means they could come back and sue you afterwards because you bought a home during the 90-day time frame. You identified a home during the 90-day time frame that you were married to them. And now they can sue you and you have to pay them the commission that was on there. Now, I am not trying to scare you. I'm trying to educate you. But I need every single one of you to commit to being educated. And if you're being asked to sign a form, understand lots of realtors are doing it now. And I think it's a good thing. But do not sign anything unless or until you understand what you're signing. Ask them, how long does this last? What happens if I choose not to use you as my realtor? What happens if I change my mind? Is this an exclusive agreement between you and I only? What you need to know about what happens if I agree to pay you this much money and the seller only agrees to pay this much. Am I really responsible for the difference? Ask the question of the realtor. Find out what they're going to do in those situations before you sign the piece of paper. This is required on August 17th. Many realtors are implementing it now. You need to be educated. Next week, probably the end of next week, I'm going to do a live stream dedicated completely to this, walking you through it, helping you understand everything you need to know about that document, not from a realtor, not from an attorney's perspective, but from the perspective of a friend who is worried about you signing something you don't understand what you're signing. And I am that friend, and I am worried about you. And I'm worried about you having one of the few people in the real estate industry who don't have ethics as the top concern on how they take care of their clients. Most realtors, super ethical, very, very ethical. I know a lot of amazing realtors. Some of them are watching right now. I appreciate you very, very much, and you do an amazing job. But you know, if you are a realtor, you know there are a lot of people who are not the same way. That they don't take the job the same way that you take the job. They don't think of it the same way. They don't have their buyer's best interest at heart. They have their own best interest at heart. And so you have to be educated. Allow me to educate you. But if you do end up being presented with one of those agreements between now and the end of next week when I have that live stream, ask questions. Ask more questions. Ask them, hey, can we just make it for this one property? And then I'll sign another one and we can get to know each other better. It's okay to date a little bit before you jump into a long-term commitment. If they're not willing to do that, maybe you should sign it anyway because maybe they are the right agent and they understand what their value is. Or maybe they're just trying to get you to sign something that is purely in their best interest and they're going to try and strong arm you. So you've just got to understand the difference, and it's hard to see. So I appreciate y'all listening to me. I appreciate y'all trusting me. Remember, I'm interviewing for the job of being your lender. So if you want to sit down and have that interview, scan the QR code, download my mobile app. It's got a great payment calculator in it. And I really, really appreciate your trust and the trust you put into me when you send your friends and family my way, because I do lots of different types of loans, and I'd be honored to take care of you and anybody you know who's looking to purchase or refinance a home. Thanks everybody for listening. My camera stayed on the whole time, so we're going to have to duct tape some ice packs on there every time. Anyway, thank you so much for listening, everybody. Have an absolutely wonderful evening and have a great week, and we'll talk to you soon. Bye-bye.